Okay, hopefully everyone can hear me clearly now. Apologies for that. There was some issues with the mic not working, but now we're back. We are starting a little bit later than usual. Hopefully it's not too loud. If you do have any issues with the sound, do let me know and I'll try and sort that out as best as I can. All right, so let's get into it. So CPI, what is it with the US CPI? Thank you very much for joining me, by the way, and jumping onto the live stream. Don't forget to share with your fellow traders and friends about the CPI report as well and the preparation. So what is CPI? So it measures how much consumers are paying for retail goods and services as well. And then also the way it's measured is it takes a measurement from 26,000 retail outlets, 4,000 housing units in 87 urban areas. So and prices are collected on 80,000 different goods and services as well altogether. That's quite accurate detail that is provided by the CPI report. Do let me know in the chat if you can hear me. If you can't, I'll try and sort it out, but hopefully everything should all be fine. But as I was saying, so the key measurements then, part of the CPI report, you have housing, that makes up 42% of the report, food and beverages, about 14%, transportation has 18%, and then you have medical care, 8.5%. And remember, you also have the core goods, core data as well, which excludes food and energy. Somebody's saying they can't hear me. Oh, you are on mute. Oh, why'd you scare me like that, man? That's sad. Don't scare me like that. I want to give this good information to you guys. So if you can't hear me, then it's just me going through a bunch of screens, which is not helpful at all. So key thing to remember, it's a very accurate report on what's going on with inflation in urban areas. Doesn't include the non-urban areas. So, but still quite a very, very important heavy report that we're expecting today to see how that might influence the Federal Reserve a day later with their expected 50 base point rate hike at the FMC meeting that we get tomorrow. But one of the other things to be aware of as well, they have the seasonally adjusted data that is preferred as to what's going on within the economy now without the effects of weather and production cycles. So that's usually seen, so the month-on-month release is usually seen as the big, as one of the, the big part of the report. But I've changed stuff around a little bit. So the CPI year-on-year figure, that's what's going to, all the releases really, but the CPI year-on-year, where inflation is at now in the US, is going to be very key for our trading today. So what's the difference between PCE and CPI? The main difference is that PCE places a lower weight on the prices of gasoline and of residential rents and focuses on the nation as a whole rather than just focusing on urban areas. Also, another thing to consider as well is that CPI measures a fixed basket of goods, whereas the PCE is able to kind of be dynamic and malleable in measuring what are consumers really paying for, right? What are they actually buying? If there's, for example, in the CPI report, it'll measure the price of chicken breasts, whereas if they become very expensive, then there might be beef that people are actually buying more of. So the PCE price index will incorporate beef prices a lot more than chicken prices, or may remove the chicken prices altogether and just incorporate beef prices as an example. So it's malleable, whereas the CPI index that we're getting today isn't. How does it affect the markets? If you've been trading CPI and you're still not unsure, and you're still unsure of how the markets are going to react to CPI prints, either way, then let me clear that up for you. Or if this is your first time trading the CPI report, then good luck. You're in for one hell of a ride if this is your first release or one of your first big releases. So the dollar tends to strengthen when the economy is growing. And in this case, with the Federal Reserve being very hawkish with their tightening cycle, inflation is their main goal at the moment to bring it down close to the 2% goal that they've set for themselves. So if you do see a much higher than expected inflation compared to the forecast figure, you're expecting the dollar to see a movement towards the upside. And we'll also go through the deviations as well for the economic release, so that we can understand how big of an effect has it had on the dollar, stock indexes, bonds as well, and other currency pairs too. So for the stock market, underlying inflation or the core CPI data is quite important too, as if there's a sharp rise within a month, that can lead to stocks taking a hit. But I think if you've been seeing how the markets have been reacting now, any upward tick of inflation within the CPI report, or not a pretty sight being presented to the markets with the data, will lead to has led to stock markets taking a huge hit, and that has in the past lasted for quite a while, more than just within the hour of trading, but at some points, not until maybe another big release has come out, maybe the following week. There is that possibility there. But of course, that's something to bear in mind with the stock market, that every single CPI report is going to be important. Then for bonds, high inflation read can lead to high yields in an expansionary environment. And also within this tightening environment, traders will try and price in high yields in anticipation of higher rates of interest. And then, of course, bond prices, if you do have high yields, you have smaller or cheaper bond prices as well. So bond yields go higher, bond prices go lower. If you're unsure of how the bond market works, ta-da, there you go. So that is how the markets would react in the basic way to a CPI report. Now, the previous report that we had, so the all items index increased 7.7% for the 12 months ending October, which was the smallest 12-month increase since the period ending January 2020. The energy index increased 17.6% for the 12 months ending October, and the food index increased 10.9% over the last year. All of these increases were smaller than for the period ending September. So there's signs of slowdown that is evident, but it depends on how strong that slowdown is, or whether or not it's slow enough for the Fed to definitely cement a 50 basis point hike for the December meeting, or maybe to shorten their timeline of tightening in the future into 2023, and then how soon will they look to maybe cut interest rates. So next point, where is the economy at the moment? That's also one thing to be aware of and understand what's going on. So non-farm payrolls, you had that big bit of data that came in at 263k compared to the prior of 261k. Just to bear in mind, all these economic indicators that we're looking at, or where the economy is now, would show how strong inflationary pressures can be or are within the US economy. Okay, so it's important to note how strong of an influence will these economic indicators have on the CPI print. Remember, if you have more jobs, there's more spending that goes on. Okay, and of course, the high demand leads to those businesses maybe having to increase their prices in order to try and balance the supply and demand that they have within their business or within the economy too. So the unemployment rate remained unchanged at 3.7%. Average earnings year on year was at 5.1%, higher than the prior 4.9%. Employment cost, not really much of a change at 1.2% compared to the prior 1.3%. PC price index year on year was at 6% compared to 6.3% as a prior. Core PC price index was at 5% compared to the prior of 5.2%. ISM manufacturing prices paid was at 43 versus the prior 46.6. Productivity as well in the US was at 0.8% versus the prior of 0.3%. Import prices better or higher than the previous at minus 0.2% versus minus 1.2%. Export prices were also higher as well at minus 0.3% versus minus 0.8%. And then PPI, right? The big release we had last week for the week completely crushed the markets as well, right? That didn't paint a pretty picture. PPI was at 7.4% versus the prior of 8%. Okay. Now, let's keep going. So one other thing as well, recently we had the Michigan one-year inflation expectations, which were at the lowest since September 2021 of 4.6% compared to the prior 4.9%. That measures, right, what consumers are feeling about where they expect inflation to be in the future. And if they see it as the 1 year ahead that inflation is smaller than what they previously expected, that could also lead to small amount of spending in the US economy as well if they feel like they're being hurt financially. But that doesn't always necessarily mean that. There's not a very strong correlation. Sometimes you can have inflation expectations which are lower, but consumers are still spending a lot of money buying goods and services. But that's another thing to be aware of where the economy is at the moment. Now, the triggers then for the economic release. So this is just a summary of the investment banks and where they see the highs and lows for the different economic releases we'll be getting today. So the month-to-month, they see a high estimate of spot 4% with a low estimate of the range at minus 0.1%. The year-on-year with a high estimate of 7.5% and a low of 7.2%. The core month-to-month with a high estimate of spot 6% and a low of 0%. And then the core year-on-year, they see a high estimate of the median, or excuse me, should I say analysts are looking at a high estimate of 6.3% with a low range at 6%. Then the sentiment and views that we have as well, we've got about 15 minutes. So PPI, as I said, caused a sell-off. You had a higher than expected data compared to the forecast. You've seen the TICKSTRIKE fly. Stocks take a hit as well. Bond prices also took a hit from that, as did gold. Inflation, and more inflation. That is the current sentiment now, this week, before we get the FOMC meeting, and also the other central banks too, with the Bank of England on the Thursday, with the ECB on the same day. So that's going to be busy in itself. But at the moment, what is the big focus? Inflation. Okay, that's the big focus at the moment now, before we get those important interest rate statements and rate decisions. 9th of December, Wells Fargo, they said that even as we observe a respite in goods prices, the gradual decline in the bigger services sector speaks to the fact that inflation will take time to return to the target, and that the Fed still has work to do in its fight against inflation. That was according to Wells Fargo economist led by Jay Bryson, who wrote that in the note. RBC that said that people are putting more emphasis on the CPI than the Fed itself, according to their global head of FX strategy, Lignos. Bank of America said that investors have cut dollar longs almost to flat and cut their euro shorts to flat as well. Then Moynihan said that Bank of America sees signs of inflation starting to flatten out. Wells Fargo again, they expect the Fed to raise their Fed funds rate to a peak of 5% to 5.25% by March 2023. Now, it's important to understand how strong inflation, or how quickly inflation might fall, or maybe that they need to increase their rates to maybe a much higher band than previously anticipated. And that's been a constant thing. Central banks and investment banks have been continuously revising their forecast of where they see the federal funds target range. So it might not be, it's not really a surprise they're looking at a range of, or peak range of 5 to 5.25%. Goldman Sachs reiterated that they think the peak for US core inflation has passed. December 6th, they had JP Morgan's Lake saying that the US economy remains robust, a labor market is still tight, and we are past the peak of wage inflation. ING said that the US data will likely determine the direction of dollar's performance before the Fed's policy meeting on Wednesday and into the first quarter 2023. And after a recent sell-off, the greenback will likely be supported by signs that price pressures will take time to meaningfully decline. Now, in the short term, when we do get the release, you're going to see a lot of volatility. You're going to see some big moves occurring within the market. But over the longer term, there would be, from the Fed's point of view, okay, they probably are obviously going to be looking at the markets and what the CPI print comes in at, but they're not going to be focused on the short-term reaction of what the markets do. They're going to be focused on how that's going to affect the US economy overall and whether or not they need to take a longer time with raising their interest rates. I do have a lot of comments in the chat. You guys are going crazy and nuts. There are a lot of people here. I will try to get to you when I can. Fed and government views. Kashkari has said that he hopes projections that inflation will drop in 2023 are correct. If they are, you imagine we would stop raising rates in 2023. Doesn't say when in 2023 or early 2023, but that could be a scenario. Bullard said everything will go better if we reach restrictive levels sooner, making 2023 a year of disinflation. Powell said, I still think there's a path to a soft or softish landing without a severe recession. We don't want to over-tighten, and cutting rates is not something we intend to do anytime soon, and slowing down at this point is a good way to balance risks. So that was something that kind of boosted sentiment when Powell mentioned those comments within stock market, reiterating that there could be the possibility to slow down with the rate hiking path pretty soon. Treasury Secretary Yellen said, I believe we're on the right track in lowering inflation and recession is not inevitable. Opposite comments, or slightly opposite comments from Powell and the government themselves. Powell saying that it's going to be hard to kind of keep away from a softish, keep away from, the recession going out of hand. That they'll try their best to get that softish landing as best as they can. But with the rate hikes that they're going to be doing and continuing to do, that becomes less likely to happen. Is the kind of the picture that's being painted with how aggressive the Fed has been and how the markets have been pricing in these rate hikes as well. Now, market pricing. So November 10th, so post the last CPI release, you had Fed swaps that downgraded 75 basis point rate hike in December to 50. December 12th, you have money markets pricing 50 basis points of hikes this week, unchanged from the previous Friday. So more or less, I think it's about 70% on the CME Fed Watch tool when I checked it yesterday. Probability for a Fed 50 basis point rate hike. Investment bank estimates year on year, Wells Fargo sees 7.2%, JP Morgan 7.3%, as does Bank of America. Month-on-month estimates, Wells Fargo sees 0.2%, JP Morgan 0.3%, and Bank of America 0.2%. Core estimates, Wells Fargo sees, and all of them actually see a core estimate, or the core year-on-year, coming in at 6.1%. And the core month-on-month estimates, other than Bank of America at 0.3%, the other two are looking at 0.4%. All right, so this was the last release that we had. Let me just bring this up on a big screen for you to all have a look at. So this is the previous release, just a history of what happened in the markets, just to kind of show you how the markets reacted here. So about 10 seconds before the previous release of what we had seen on November 10th. So one thing to be aware of is that the markets will try to move, as you can kind of see here, before the reaction, before the data has even come out. So we had seen that inflation just before that market reaction that we had. So inflation was much smaller than anticipated. All right, so 7.7% for the CPI year on year. It's a 0.2 deviation, and the stock market just roared. Okay, and the dollar took a huge hit there as well. So that was the initial reaction. So let's kind of creep along a little bit more, kind of just see a bit more of the data on the markets. You can still see this is after about 5 minutes of the release, or around 5 minutes of the release coming out. You had seen markets were still up as well. So I've kind of skipped there. Okay, so that's something just to kind of show you. So if you do have, I'll kind of go back a little bit. Okay, so if you do have a smaller than expected report, or smaller than expected CPI print compared to the forecast, this is what you're kind of looking at here, right? stocks will appreciate. The dollar would see depreciation in anticipation of the Federal Reserve going with a 50, or maybe shortening their timeline of going with these rate hikes that they've been doing for the past or nearly a year or so, from March. So that's one thing just to be aware of. But of course, if you do get a higher than expected inflation print, you'll probably see the opposite reaction within the markets. So just to be aware of, this was historically what had happened. Let's go to deviations. We've got about 6 minutes left, and I want to kind of get through everything. Let's get our deviations up and running. So let's go to our CPI. Here we go. So this is how the markets reacted, right? So you had the data more or less going in one direction, okay, towards the downside. We had smaller than expected figures compared to the forecast. And this is the biggest reaction that the Nasdaq has seen since we had started covering this report all the way back from February. So 1,520 ticks up. Okay. The dollar yen had seen 124 pips down. Just remember, so this figure here shows you the initial reaction that has occurred within the market. Okay, so I want to capture, that goes from the start of the candle to the wick, okay, where it ends, just to capture the whole movement of what had happened. And then the brackets represents the movement 10 minutes after the release. And that doesn't go to the wick, that just goes to the end of the candle. Because of course, the big amount of movement would have happened from that initial market reaction on that one candle. So hopefully that kind of makes sense of how this kind of works. But you can see that and from what we've seen in the past, even if you do get a 0.1 deviation on the CPI report, either way, but all the other indicators are going in the same direction as well, right? If they go up or down, then you will generally, from historically what we've seen, you would get a strong market reaction from the CPI release. If we get more of a choppy, mixed reaction within the markets or within the figures, where we have a CPI year on year going higher or than expected, or the core data going lower, or whichever way it is, if you get mixed data, that's going to make it more difficult to kind of see which direction the market might go. But if you do have the majority of them going in one direction, then then the market could go down that one route and just decide, all right, inflation overall is either going down or going up. So to be honest, this is sensitive. The markets are very sensitive to this data, as I said at the beginning. If you're unsure of that, you should be very focused on what the CPI print. Today we're going to be focusing on the CPI year-on-year print. Okay, for today's sessions, we've got about 3 minutes left to the release. But here we go. So what are the biggest reactors then, currency pair-wise? So of course, the dollar yen was the biggest reaction. So I had seen the biggest reaction. Then you had cable, okay, which had seen the second largest reaction. Then in third place, you had the dollar CAD and the euro dollar as well. Okay, gold had seen 227 ticks towards the upside. And then out of the bonds, so the 2-year bond had seen the bigger reaction with 101 ticks towards the upside. Of course, bond prices going up and the yield going down. All right. So, as said, about 3 minutes left to go. As said, if we get data going all in one direction, expect a bigger move, similar to what we've seen in the past. If we do get a mixed choppier, if we do get a mixed report, you'd expect a bit more of a choppy reaction, maybe an undefined move that could occur. If you get data that's all in line with expectation, it depends. You could get a market reaction where in the past we had seen where the stocks had liked that and taken it in a good way, saying that inflation isn't overheating, but it's also but the other flip side is that it's not going down, So that's one thing to be aware of too. If you do get data in line with expectation, that could also confuse the markets as to try and find which way they want to go, what kind of sentiment do they want to take on. But as I said, be prepared. So put yourself in your seat, strap in. We got about 2 minutes left to the CPI year-on-year print. Okay, 1 minute. Okay, CPI year-on-year, we are inbound. Let me get my TICKSTRIKE up and running, and we've got FinancialJuice up and running as well. Okay, let's see what this baby does. Oh my goodness. Oh, golly. What are bond prices trying to do? Take it easy, son. Okay. Right. Okay. Are we all ready? Oh my gosh, who said bullish or bearish? Now's probably not the time to ask. Okay, 10 seconds left. 10 seconds. 10 mere seconds. What do we got? 7.1%, 7.1%, lower than forecast of 7.3%. CPI month on month, spot 1%, lower than the forecast of spot 3%. Core CPI year on year, 6%, lower than the forecast of 6.1%. Core CPI month on month, spot 2%, lower than the forecast of spot 3%. There we go. So markets, S&P 500 going to the upside, Dixie towards the downside. As said, S&P 500 up, Dixie down. Bond prices are going up as well. Let's capture gold. See what you do. What you do, son? Okay, that's gold going up as well. All right, that was a nice reaction. To be honest, see, that doesn't look as big as the last reaction that we had. But hey, there we go. As a spot 2% deviation on the CPI year on year. More or less, markets, more or less kind of where maybe investment banks were looking at as well. But let's just kind of measure this initial move here. I just want to see if on the S&P 500 we got a bigger move than we had last time round. Where are my deviations? Where is my deviation? Bring up the deviation. Let's see. Okay, CPI. Where are we? Am I blind or am I just looking? There it is. Okay, so that was 360 ticks towards the upside on the S&P. Last time round, we had 382 ticks towards the upside. Let's have a look at the NQ. Let's see, what did you do? Okay, let's keep an eye, see what happened. Okay, 947 or around that on the Nasdaq. Look at the Dow. I will look at the I will look at the dollar yen in just a moment. I want to get these indexes out of the way with first. So yeah, not as big as a. See, all the data was lower than expected. Still a decent reaction. So that was 533 ticks towards the upside, so smaller than what we had seen last time. Okay. Let's see what we got on the dollar yen. Probably didn't get 100 in. Oh my goodness. That's 187 or 188 pips down on the dollar yen, which crushed the market reaction compared to last time round. Let's look at gold too. We'll also look at WTI as well. Don't worry. Okay, gold. 300 ticks there. Bond prices. Well, whoever tried to buy in early, just before the release, probably lucky on that. 82 ticks was the upside on the 2-year bond price there that we have there. Now, for those of you who are still with me live at the moment, hopefully you found the information useful. I'm turning to Sean Connery. Hopefully you found that information very useful. So, FinancialJuice, right? Where I'm looking at the data, right, and where we're getting the headlines from here. FinancialJuice, if you're unsure of what it is, it's a live voice and text service. What is the key thing for a trader? Right? What do you guys think is a key thing for a trader when you're trading the charts or trading when you're trading in the markets, particularly if you're day trading, right? It's information. You want to keep an eye on what's going on at that point in time. Why has there been a market reaction? If there wasn't an economic release, you want to understand maybe it's what Powell might have said during his press conference or outside of his press conference, or maybe it's ECB's Lagarde or Bank of England's Governor Bailey has said something wacky, or something's gone on with Ukraine and Russia again, or China where the COVID easing maybe is not working as well. You want to stay abreast of the information as much as you can in order to understand why the markets are moving in a certain way. The only way you can do that is by having access to a live voice and text service, such as FinancialJuice Pro. So FinancialJuice, okay, on our website here, if I just kind of close TICKSTRIKE down a little bit. So we have our live headlines coming through here. Of course, with the economic releases, also live in real time as well, as is the voice. The live version has a delay of 10 seconds across the whole site, right? You don't want a delayed version, okay? If you're day trading and you're making decisions, and you want to be able to make them as quickly as you can, you don't want a delayed service. So the best thing to do is to have the pro version of FinancialJuice. So what are the other benefits of FinancialJuice Pro? So not only do we have the live data there as well, but you can also set your own economic triggers as well. So let's say for the CPI print, you can set your own economic triggers. Let's say you want to put a buy or sell alert. Ignore this figure here. That's just the forecast. It's not us telling you what to do, right? So I can just say, let's say for 5.6%, I'll buy, or 4.5, I'll sell. Okay, well actually let's do 9. I'll sell. This is something you can kind of chop and change, all right? But you can also, once you've kind of set this, your economic triggers will also be in real time as well, right? So that's also one of the other benefits of FinancialJuice Pro. Now, in order to get FinancialJuice Pro, the first thing you need to do is to sign up to FinancialJuice on the website that we have. Okay, sign up to the newsfeed, make an account, have a username with your email address. Then you can click on a little button here which says Go Pro. Once you've signed up to, FinancialJuice on the website, you've clicked on Go Pro, then you can subscribe to the FinancialJuice Pro nice and easily. The only thing you will need to do is once you've signed up for Pro, is you need to log out and then log back into your FinancialJuice account to allow you to access Pro. Okay, that's just it's just a system that we have at the moment, just to kind of reset, let's say your site for you, just to set you up on the platform that we have. So FinancialJuice. So let me get that link for you guys here. Whoops. There we go. So I'm going to put this link in here for you. That is there. That's FinancialJuice. So that's going to the homepage. Remember, as I said, create an account first before you purchase FinancialJuice. If you don't create an account on the FinancialJuice newsfeed, it will be tricky and harder to set you up with FinancialJuice Pro, and we don't want anyone to be unhappy. So please follow the instructions, and I'm sure you guys will. So, just seeing other stuff here too. Futures indicate that traders see a growing likelihood of a 25 base point Fed hike in February, following a 50 in December as a result of a softer than expected November CPI. Fed swaps downgrade peak policy rate to 4.88% in May 2020 by May 2023. Okay, see stuff like that. You want to understand what is the sentiment of the markets, right? You want to understand why the markets are moving in a certain way. Dollar's still taking a hit. So that's FinancialJuice. TICKSTRIKE, yes, somebody I have seen. You guys, there's just so many people in the chat here. it's kind of hard to keep an eye on you guys. It's like, you are like the school children. I'm the teacher here, or maybe you're like grad students, students at university, college, if you're in America, and I'm trying to teach you, and there's so many questions that are going on. It's a bit too much to handle. But hey, that's good news, right? Becoming very popular. So all thanks to you guys. Don't forget to like the video, subscribe to the channel, share the video as well. Get the word out there that of course, if you found this information useful for your trading, then definitely I would definitely recommend you guys to share the love, spread the love, get the word out there. Right, so TICKSTRIKE. So if you're unfamiliar with what TICKSTRIKE is, then TICKSTRIKE allows you to listen to order flow and in other words, see how strong the buying or selling momentum is within an asset or asset classes. Okay, so you've got currencies, you've got crypto, you've got stocks, futures, ETFs and ETNs, and internals as well with your VIX. You can also use that. So what is TICKSTRIKE then? So what is this little thing that we have here? So this is the ticker or the box that we have, and you've got a plus sign here with a number, and you've got a little gauge here, and you've got a color going on. What does that mean? So if you have a plus sign on your ticker, that shows you that there is buying momentum going on within that ticker. Okay, I can bring up GPUSD because that will give you a better visual rather than looking at the dollar yen and cable there. So as said, so you can see that the amount of buying that's going on, and then with the minus figure here, you can see the amount of selling. You can see that that's showing you selling that's happening with the minus figure. So what's this 15, 1, 6 and all that I'm seeing? So we have a dial on the ticker that allows you to adjust the level of sensitivity. So 1 is the most sensitive to market reactions. So if there's a little bit of selling or buying that's happening, then TICKSTRIKE will go off. But if you want to decrease the amount of sensitivity that there is within the markets, if you put it to 15, which is the highest level, that's the least sensitive to market reactions. And only when there's a big amount of movement compared to what it trades historically, then only then will TICKSTRIKE go off for you as well. Okay, so that is TICKSTRIKE there. So what we, of course, if you're a day trader, if you want to capitalize on potential trades or scalp the market or maybe manage your risk, then TICKSTRIKE is a perfect tool for you to get used to or get your hands on. Or if you've been playing around with a 7-day free trial, then, again, that opportunity is there for you to take on the world of trading. But we'll put in the link to TICKSTRIKE. There is a 7-day free trial going on with TICKSTRIKE at the moment. That I've put the link there in the chat. Don't forget, with TICKSTRIKE, if you're unfamiliar with what it is, if you're not sure how to use it, have a little play with TICKSTRIKE. Don't feel afraid to have a little look at it, get used to it, and then when you feel ready, of course, the same with the FinancialJuice, the pro version of FinancialJuice too. If of course you have the light version of FinancialJuice, get used to it, how it's kind of run, what kind of things to expect, what we kind of cover, And when you're ready, then definitely go and then go for it. If you love the product, of course. So that's TICKSTRIKE there. And then, of course, so where did I get the deviations, or how do I get my hand on the deviations, right? That I showed for how the markets react to the economic releases that I present to you guys. So what you want to do is you want to you can sign up to a MACROACE mailing list here. That's completely free. You get the deviations for the upcoming economic releases that we have for the week. Okay. And also you get a short summary of a rundown of what to expect for the Asia session, the US and European session, and a summary of the weekend news. It is short. It's not big and expansive with loads of graphs or fancy looking charts. It's not that. It's a block of text giving you a short summary of what to kind of expect and what had happened over the weekend as well. And it also includes a link to the live streams as well that we have for you. So that, again, that's also, as I said, that's completely free to use and sign up with as well. What else? So then finally we have unusual activity. So if you like trading unusual volume activity in stocks, you can join the free beta test group of our new service. If you like trading, and not only just stocks, but crypto, forex and futures, right? You can also use unusual activity for that as well. So again, that's a free beta test group that we've got for you guys. You can also sign up to. But as said, don't forget to like the video, subscribe to the channel, and let your fellow friends know about it as well. I'm just going to grab the video for the FOMC, okay, for you guys. So if you're on here now, let me pop in that link to the video for tomorrow for you. Oh wow, actually we've just hit 2,000 subscribers. Oh, actually, well, if you want to be precise, 2,010 subscribers. So thank you very much. You guys, hopefully, as said, you earlier on, you appreciate the content, which seems like you guys do. Let's keep that going, that momentum. I'm going to paste this link in for you. Okay, that is the stream for the FOMC tomorrow at 1 p.m. Eastern time. I'll be going through the preparation an hour before the release is expected. Bricktop, hey, congrats, way more to come for sure. Yes, thank you very much. That is brilliant. Yeah, thank you very much for your support. There have been a lot of comments here. Okay. I'm just going to work my way through the comments. If I sound quiet for a bit. Put hearts in here. Alphabet 21. Do you think bullish or bearish for big hearts? Somebody said bricked up again. Thanks, Tony. Great live stream as always. Right. Here we go. Trader Tom, use the, as I said, that you have the 7-day free trial. Have a little play with that and see what you think of it. Okay. Thank you very much for joining me live. We can still see the stock indexes haven't reversed their gains as of yet. Dollar yen is still down. Taking hammering. Actually, I want one more final thing. Euro dollar. Let's double check what that did before I leave you guys. All right. Okay. That's about 70 pips towards the upside there. All right. Thank you very much. Take care and goodbye. I will see you tomorrow at 1 p.m. Eastern time. Don't forget to share that link with your friends, fellow traders as well.